Welcome. It's a great pleasure to be on the ShareSoc platform again and to present an update on Tharisa and where we've come from in the last 6 months and where we're going and where we're heading in terms of our growth and expansion projects. And I think what really underpins our business and our strategic objectives is these long life resources that we have been blessed really to have the opportunity to develop. So in South Africa, we took an unknown reef horizon, the middle group reef horizon, which is comprised of 5 seams, MG1, 2, 3, 4, and 4A. And for the first time in the Bushveld complex, the largest geological formation for platinum group metals in the world, we co-extract platinum group metals and chrome concentrate. And this business model has really proven its robustness through the cyclicality of commodity pricing. The beauty of being able to access these 5 reef horizons through an open pit mine is that it gives us a huge resource of some 850 million tons. We have a remaining 18 years left, depending on how you structure the open pit. We have 3 pits, the east, west, and far west pit in terms of life. Thereafter, we have at least 40 years underground potential, and something we're very excited to develop in the future. If we look further north, the second most endowed geological formation globally, which is the Great Dyke, situated in the central part of Zimbabwe, running from north to south, some 550 kilometers. We have the Cairo Platinum Project, which spans over a vast area, and really our first phase is targeting merely about 10% of the resource that is underlaid. This has historically been drilled by one of the majors on the Great Dyke, and they declared a resource of some 96.4 million ounces. So if you look at the combination of the Tharisa mine as a strategic supplier of these critical metals, chrome concentrate and PGMs, and you couple that with the resources in Zimbabwe, you have significant long life, multi-generational resources. And that age-old cliche, he who has the resources is king, really comes to play in a global fight for these rare commodities, which we've seen play out in interesting fashion in South Africa over various resources that have been competed over. We also look beyond the mine gate. We don't see ourselves purely as miners. We capture value down the chain. So from the mine to pit port strategy, we have our wholly owned subsidiaries of marketing and sales, as well as logistics. And what this allows us to do is create flexibility in terms of a customer base, in terms of our supply chain, but also the ability to take opportunity of freight rates at certain ports, the ability to run out of multiple jurisdictions. As you know, there have been challenges around logistics. Having said that, we've managed to deliver all of our goods on time to our end customers. And then when we look at our product diversification, the platinum group metal basket is unique in its catalytic properties. But beyond that, there are multiple markets that are opening up, existing, whether you look at investment or jewelry, as well as the vast industry from medical to electronics. But we start looking ahead at the hydrogen economy and the vital role that PGMs will play in that. And to that end, we have been very proud of the fact that we're able to use our research and development to unlock value throughout the chain. But if we just have a look at where we've come from and what we've done, we've been profitable since 2015. And this really is testament to the co-product model of mining chrome concentrates and PGMs. We've invested over the last decade over $530 million, not an insignificant amount. And what we have focused our attention on really is extracting maximum value from that single cube of rock that we mine. It has a contained metal value, and every opportunity we can get to extract that metal is an opportunity to capture more value. Importantly, we've also been paying dividends for the last 8 years. We've returned over $90 million to shareholders. All this while investing in our business. We've also settled and repaid debt of $202 million. So what this really tells us in a nutshell here is that this Tharisa mine and the Tharisa services or wholly owned subsidiaries are really strong cash generative businesses. Over $1 billion in value in the last decade has come out of this mine. And we're looking to replicate that in Zimbabwe. And for those that don't know, the journey at Tharisa is exactly the same as in Zimbabwe at Cairo, from a greenfields exploration project right up to a robust, sustainable business that is profitable through the cycles. So when we look further ahead at Vision 2025, we want to unlock this mineral endowment through multi-generational resources, South Africa and Zimbabwe, and we using innovative approaches and thinking to unlocking that. So in summary, what is our Vision 2025? It's underpinned by our purpose statement, which is ultimately to enrich lives through innovating the resources company of the future. You'll notice that we don't talk about mining here, we talk about resources, because these are vital, strategic for the betterment of the planet, for the decarbonization of our planet. So we look at expansion at our existing operations, and we do this through optimization initiatives, through applying technology, innovative thinking, processes that we've developed internally, and that really, I think, gives us a little bit of an edge, as well as excites us and inspires us to do better and do more. Diversification is key to our strategic objective. The Cairo project is a point in case, but also the R&D initiatives, looking at new applications for the products that we mine. Ultimately, we want to become the investment of choice through this diversification strategy and unique approach to resource extraction and beneficiation. And then talking back to our purpose statement, enriching the lives of all our stakeholders. So in mining, it goes without saying that safety should be a priority. We take it one step further and we say it's a core value. It should be entrenched in every activity, in every act that we do on a daily basis. Unfortunately, we had a fatality after 7 years being fatality-free last year in October. And it really sent a shockwave through the organization to say, we thought we knew what we were doing and we thought we had everything down pat, but there were gaps. And we've reinvigorated the team. We've refocused our attention on even higher standards. And we're pleased to report that our rolling lost time injury frequency rate has reduced over the last 12 months. And post this 6-month reporting period, which is ending March, has improved even further. Pleased to report that Cairo Platinum remains project LTI free since exploration in 2018. We set up a memorial garden at the Tharisa mine just to remember our lost colleagues, family, and friends during the COVID period, as well as those unfortunate to have lost their lives at the Tharisa mine. So when we look at the last 6 months, as I said, ending March this year, it's been a challenging environment. And I'm pleased to report that we've delivered through these headwinds and really been able to deliver into the 4 pillars, which are the discovery, development, delivery, and diversification of our business. And through various initiatives, we've managed to proceed on that basis. We'll touch on the production numbers and the capital discipline, but just looking forward for the next 6 months and for the full year, we revised our guidance to produce 158 to 167,000 ounces of PGMs and 1.58 to 1.67 million tons of chrome concentrate, as well as some critical and key milestones at the Cairo project. So when we look at the vital numbers in terms of production, you'll notice that our reef mining, our ore mining, is down from the prior half-year period to 2.1 million tons. And this really was on the back of very severe weather, storms, flash flooding in the open pit, which had a material impact, and we're still catching up in terms of the backlog of waste stripping. We did, however, manage to mill, or the throughput in our plants, managed to achieve budget, but it was affected in terms of recovery of the PGMs because of the variability of the feed, and hence our PGM production being lower at 16% at 77,000 ounces. Our chrome concentrate inversely was slightly up at 1.4%, and this is really due to the fact that the Vulcan plant is starting to deliver those low-cost scavenged chrome tons on the back of the two processing plants of Voyager and Genesis. When we look at revenue, slightly up on the half year at $353.3 million, generating operating profit of $63.5 million and an EBITDA of $81.2 million. Profit before tax of $72.4 million. And I think most importantly, the cash generation is robust at some $97.1 million. And that's really testament to the generation of cash at the project. And then we sit with a very strong balance sheet at the half year of just over $205.7 million in the kitty. This allowing us to generate an earnings per share of 17.4 US cents and headline earnings per share of 17.6 cents. And for those of you on the call that are shareholders, I'm sure you'll be pleased that we matched last year's half-year interim dividend at 3 US cents. And this really in line with our dividend policy of paying a minimum of 15% of net profit after tax. So when we look at maximizing our output, we turn to innovation, and we really do believe that technology is an enabler for differentiation. And we have 3 critical sites that have enabled this. We have our beneficiation site, which is really where the pyromet work gets done. And we've been running a 1 megawatt PGM smelting facility on a commercial level, and we sell that alloy on favorable terms. This really to get our full-scale project up and running, which is undergoing a front-end engineering design scope as we speak right now, and should be concluded by October of this year, and then we'll make the investment decision whether we'll beneficiate our PGMs to final metal. This facility also allows us to demonstrate various other initiatives. Through various universities, we have the Arco Metals Technology Development Center, where we do laboratory test work in conjunction with the university, and it allows us to focus on the downstream beneficiation of both PGMs and chrome. And what's really exciting to us is the Arco Metals Renewable Energy Center, otherwise known as AMREC, which will be launched later in this month. And it's really the site of where we'll be installing our 40 megawatt solar project, but it houses the other renewable energy initiatives that we're undertaking, one of which is very exciting, which is our own energy storage solution using our commodities. And we'll be sharing that exciting development with you in due course. Moving on to, I suppose, the most significant development within the group, which is the Cairo Platinum Project. Just to remind everybody, it is a tier 1 asset. The first phase that we're looking at has an open pit life, very similar to the Tharisa mine, of some 17 years. We're targeting initial production of 190,000 PGM ounces. And it's not too long into the future that we'll be processing our first ore, which will be in July of next year. So a rapid development and deployment, the open pit obviously allowing us to do that more expediently than a deep level underground mine. We've started with our construction in December last year. The earthworks have been completed, and we have just commissioned or signed the trial open pit mining contractor on site, and they will start with the first box cut in the first phase of where we'll be mining. And the reason for that is really for us to get the processes, the grade control in hand before we get into bulk full-scale mining. We also appointed the civil contractor, and they'll be pouring cement in this month as well. So a lot happening in June of this year at Cairo, but these obviously building up to the mechanical and the construction work delivering into July next year. As mentioned, this project will have a significant impact. We currently have 440 people on site, and we have been lost time injury free, fortunately. We are compliant to IFC standards, and we have environmental approvals to date for mining, processing, overhead power lines, and we anticipate the balance of them to be forthcoming in short order. And we are fully permitted for the life of the resource. So it's not for the first phase, it's for the full extent of that 96 million ounces. Just to refresh everyone's memory, we're only targeting 10 million ounces in our first phase. So lots of opportunity for expansion and growth. In terms of capital, we have communicated our capital budget of some $391 million, and that is to first ore in mill. We have multiple funding streams in play. The first, which was a successful and unique listing of a US dollar denominated bond on the Victoria Falls Stock Exchange, where we raised $36.8 million. And it was really great for the team to be the first to access liquidity within Zimbabwe, and in fact attract some South African financial institutions as well. We also announced recently that we secured financing with limited recourse of the Tharisa PGM stream from a consortium of two banks, SocGen and ABSA, for some $130 million. And this really is the equity component that will be invested into Cairo itself. We've signed term sheets in terms of the senior project finance facility, and that is in the order of $260 million. And we anticipate that to close in the fourth quarter of this year. So when we look at the commodities, there's a lot of debate about battery electric vehicles and, the demise of the internal combustion engine. And we really have maybe a complementary view to that, because we do believe in a diversified energy mix, and battery electric vehicles will play a critical role. But when you look at the rollout of BEVs and the penetration, we think it's limited from a number of points of view. One, from a resource perspective, in terms of the natural resources that are required to electrify the world's parking lot. Secondly, from a cost perspective and accessibility to infrastructure. So we still believe that internal combustion engine, certainly in the medium to longer term, has a role to play and will become cleaner and more efficient, and leading into what we believe is most probably the middle ground solution, which is the hybrid drivetrain. So to that end, we see increasing emission standards with Tier 4 North American standards and Euro 7 emissions coming into play, which require more platinum group metal loadings into the autocatalytic converters. But having said that, there is a very strong support for the hydrogen economy. And it's the first time that we've seen a united belief through policy, through capital and technology, that the hydrogen economy can be deployed at scale to create energy independence. And I think the Ukraine-Russia invasion, or the other way around, Russian invasion of Ukraine, has really highlighted the need for countries, sovereign territories, to be energy independent. And hydrogen really does provide an opportunity for that. Then when we look at Zimbabwe supply coming on stream and the expansion projects that come out of South Africa, we really believe that the thematic at the moment is supply side constraints. And we'll talk about the restrictions and limitations and obstacles to produce in the Southern African context. When we look at chrome, you'll see that we've had an exceptionally good run on prices, currently trading at around $300 per ton. This is really on the back of Chinese port stocks dropping to critically low levels, as low as 1.4 million tons. They're hovering closer to 2 million tons today, but still less than 6 weeks supply into the domestic demand. And we haven't seen demand really fire on all cylinders. It's been fairly muted and stable. We do believe that if there is a stimulus package, we'll start seeing demand picking up. Again, it's a supply side challenge, with logistics challenges in South Africa, with load shedding and curtailment, creating obstacles to meet guidance and production for most producers in South Africa. Just to remind everyone, the Tharisa mine is a critical source of these raw materials, which end up primarily in the ferrochrome and stainless steel industry, and we supply around 10% of Chinese requirements. And South Africa, having the largest resources in the world in the Bushveld complex, supplying 80% of Chinese chrome needs. China has no chrome resources of their own, so they're wholly dependent on the import of these critical materials from South Africa. The balance of our production, around 20% in this first half, growing hopefully to 25% in the second half, is what we refer to as specialty grade chromites. These are your foundry and chemical grades, and these are more globally diversified products and enjoy a premium to the metallurgical price. So when we look at the PGM basket price, we averaged around $2,200 for the half year. That has come down to around $1,800 a PGM basket price. And this really impacted on the softer, lower rhodium prices, with some inventories in China being liquidated into the market and very soft buying. It is a fairly illiquid market, so there are two schools of thought that it will remain at the current levels of $6,000, or there will be a recovery on the back of buying. The rand has also helped us during this period by weakening as a dollar revenue earner and a South African rand cost-based structure. It's certainly protected us from some of the inflationary pressures. So touching on those tailwinds and headwinds, I think we've been supported by our co-product business model in this half year, buoyant chrome commodity prices. And it's almost counter-cyclical when you look at it being late cycle, early cycle commodities, PGMs versus chrome. We really enjoyed when both do well, but invariably we've seen them work in tandem and really supported our business model. We've touched on the fundamentals being extremely strong for both. On a macro level, the weaker rand supports our business. We've seen bulk freight rates drop around $10 per ton, which really was on the back of that supply chain crunch that we saw in the prior year, 2022, which is normalized, and we're seeing that benefit, which really reports straight to the bottom line. We've spoken about the stainless steel and hydrogen economies being positive and the outlook being supported by multi players, be it governments, be it financial institutions and technology providers. So again, that theme around supply is really driven by the headwinds of electricity supply issues in South Africa, and the rolling load shedding that has impacted not only civil society but industry as well. So if you recall, our Tharisa mine is mainly reliant on diesel as its primary source of energy. So we're not a very intensive power user at 27 megawatts. We did invest in standby diesel generation the last round of load shedding. And what that's allowed us to do is synchronize our generators so that we can feed back up to 25% of our power utilized into the grid. So we haven't necessarily been disrupted by load curtailment because we can offset the power requirement by our diesel generator. Where we have been impacted, where there have been power failures or blackouts, entire shutdown of the grid. And this has impact in terms of not giving us enough warning to run our standby generators and creates chokes and process issues. But beyond that, we've managed and navigated the curtailment relatively well. I think what's important and critical to all industrial users is the energy independence and supplementation of your energy with renewable energy. And we're very pleased that our environmental approval has been granted for our 40 megawatt solar project, and this was expedited through the Presidential Investment Scheme, and very pleased to report back to everybody that it works. And we got our EA approval in 53 days. So very pleased. So something positive in terms of the initiatives. In terms of transport, it's very well documented. Transnet is in a continuing state of decay, and whether it's theft, maintenance, or just poor availability of rolling stock, we have had to move most of our shipments from rail to road. I think what's encouraging, if we just look at something positive, is that industry is starting to get involved with Transnet and starting to provide solutions in terms of private and public partnerships to help solve these solutions. It's not a quick fix. We are fortunate enough that we are close enough to transport our goods by road and are not landlocked and require rail. So we do have that flexibility, as well as being able to export out of Mozambique through Maputo. One shouldn't underestimate the impact of geopolitical uncertainty, the impact on inflation and interest rate environment. While we do have a counter in terms of the weaker rand as a business, we can't underestimate the impact it has on our employees and the cost of living and the general morale of South Africans and Zimbabweans. We are resilient as a nation, and both nations, in fact, but it really is taking its toll on people's well-being. So impacting productivity and just general well-being. Crime and corruption is a major issue in South Africa, and it impacts everybody from day-to-day life. And it's something that we invest a lot of time, energy, and effort in to protect our people, our resources, and our assets. But it is disruptive and destructive. And we can see it well publicized throughout the country. And then we did speak about the weather. Being an open pit mine, we are subject to the inclement weather, and we were impacted in this first half. We have put measures in place to mitigate some of those risks going forward with external dewatering as well as additional pumping, but looking at different strategies, in-pit water storage as well, so as to allow the reefing faces to continue mining. So it often goes without mention or notice that we do make a huge impact on people's lives. If you look at across the group with contractors, we employ just short of 4,600 people, 440 people mobilized in Zimbabwe, a country with a very low employment rate. And when you take the multiplier effect of at least 10 people, the business that we do on a day-to-day basis positively impacts 45, 46,000 people. And that gives us the conviction and the hope to continue doing what we do. Importantly, we have a strong female representation of at least 25%. We're looking at targeting 30% in the future. And we have excellent relationships with our unions and our employees on site. We've just coming towards the end of a 4-year wage agreement, and we've started already with preliminary engagements for the next cycle, which is in June next year. We take our engagement with employees as a very serious and caring approach to the well-being of our employees. And to this end, we focus a lot on education and wellness, not only for our employees, but also for the communities within which we operate. So we provide adult education training, as well as support, whether it be through schooling modules, maths and science initiatives, skills development, and importantly, donating internet, IT, an IT center, as well as support and maintenance from there. In terms of the environment, there's no doubt that mining has an impact, but we have committed to reducing our footprint by 30% by 2030. Our solar plant goes a long way in South Africa to achieve that, as well as looking at new fuels, additives, as well as e-fuels, and looking ultimately at hydrogen or hybrid type of fuel drivetrains for our yellow fleet. We're also kicking off a 30 megawatt project, solar project or photovoltaic project in Zimbabwe, which will come in most probably 6 months post our commissioning of the processing plant in Zim. So just touching on our financial highlights, we've spoken about the robustness of our business model, the co-product, and this really unlocks the key competitive advantage of being a low-cost producer. If you want to withstand the volatility and cyclicality, you need to ensure that you're in the lowest cost quartile. We generate some significant cash, $97.1 million in the first half. And what this has allowed us to do is continue to invest in our business, which is critical. And we've seen the impacts of not investing in growth and future productivity, as well as allowing us to pay dividends consistently. We've spoken about the debt facilities, and really what this does is allows us and positions us to grow. If we look at a net cash position of $112.7 million, that's been generated through the Tharisa mine. So when we look at the revenue mix and the spread across our commodities, you'll see that chrome has grown in its importance on the back of that strong $247 price achieved in the first half, and it accounts for 48% of our revenue X the mine. In other words, you've taken the logistics anomalies out of it, so it's an X works price, with PGM slightly lower at 45.5% on those lower prices. Then our sales and marketing and trading business generating some 5.8%. You'll still see that rhodium is a significant revenue earner for us in the PGM mix at some 47%. We do benefit from a very high, almost 10% rhodium component in the Tharisa mine split. If we look at our gross profits, in spite of the headwinds and the inflationary pressures, we still maintain a very healthy 23.7% in the first half, generating $93.6 million. The weakening rand, some 15.7%, partially offset the impact of inflation. We had inflationary pressures on explosives. This half less so than the prior period, 1.2%. Diesel, a significant cost driver for us at 16.2%, and that's obviously dollar linked. So there's a little offset other than the rand. And then the landside logistics, again impacted by that fuel cost. Having said that, in dollar terms, we do benefit, and with the freight rates dropping, some $10 saving from the comparable period. Importantly, we've delivered a 6.2% dividend yield at the time of this presentation being drafted, with 3 US cents being declared at this interim period, matching last year's half-year interim dividend. And so we're very pleased that we can maintain this capital discipline and capital allocation while we are embarking on a very aggressive growth campaign in Zimbabwe. So we spoke about investing in our business, and to that end, we've invested some $49.3 million in this first half, of which $18.3 million was spent in the Cairo project, with commitments, orders and deposits being paid for $60 million into that Cairo project. We are looking to spend quite a big sum before the end of this financial year of some $160 million, and that just talks to the ramp up and the acceleration to meet that July date of first ore in mill. I think I did mention that we have invested over the last decade almost $530 million in the business. So we talk about the strong cash flow generation, and you can see this chart. It may not be clear at first glance, but the dividends are in the bar chart at the bottom, the light or darker blue, and you can see the consistency of the dividend payment. FY 2019, we skipped the interim dividend on the back of uncertainty around COVID, but we maintained a payment nonetheless at the full year. The capital investment in the lighter blue just illustrates that $530 million that's gone into our business, stay in business and expansion capital, and then the debt that's been repaid. So really highlighting and illustrating our capital allocation and the fact that our balance sheet is under leveraged and is ready to take on some of that leverage for the Cairo expansion. And this talks to our cash on hand of some $205.7 million. You'll see some of that is early debt financing for the Cairo project, and we have net cash of $112.7 million and total debt of $93 million, of which $48.4 million is short-term debt and new debt facilities. And this gives us a negative net debt to EBITDA ratio of 1.4 times and a net debt to equity negative of 16.9%. Again, talking about our balance sheet really positioned for growth and for taking on additional debt. So in conclusion, really, we see the Tharisa group as a value proposition. The investment case is strong, and you can see it on any which multiple you choose to look at us, on a comparable basis to our peers on a price to earnings basis, we trade at just over 2.2 times compared to an average of six times earnings. Our EBITDA margins throughout the cyclicality, and we've shown you the good and the bad here, has remained positive and robust. And this talks to the co-product and low-cost producer basis that we have in terms of our business. On a price to NAV, less than 0.4 times, screaming value, and then the NAV growth since 2016 at some compounded annual growth rate of 14.9%. So with that, I'd like to close and possibly stop sharing, or I'll just pause on this slide and then hand over to the moderator, Paul, for Q&A, if that's okay with you.
Thank you. I will, I think Pavlina will probably change the slides, although this one isn't a bad one to cross-refer back to. Before we go on to questions, one of the benefits that I get of presenting is that I get to ask my own questions. And it's a very enlightening presentation. You spoke a little bit about the difficulties that you're facing in South Africa, and I think the electricity issue is one that's well known, that gets quite a lot of publicity. What difficulties do you anticipate facing in Zimbabwe? Are they comparable, or will your energy be future-proofed? Will you have your own on-site electricity source right from the start there? What are the concerns and the opportunities, the differences between Zimbabwe and South Africa?
Yeah, absolutely, and I think it's a great question. So from the outset, we ensured that we sourced our grid power from a key strategic site. And what does that mean? It means that it's the last electricity distribution site that will go down in the event of load shedding or power curtailment in Zimbabwe, and it's called the Sulu substation. And we're running a power line and our own substation from there on site. So that's the first mitigation measure. The second is that we are looking at procuring direct power from neighboring SADC countries in the event that the Zimbabwean grid cannot supply to that key strategic site. And we've learned this lesson from the very well-established mining industry in Zimbabwe and the Great Dyke. So we're not pioneering here. We're taking a leaf out of the very successful miners on the Great Dyke. And then thirdly, as mentioned, we have committed to a 30-megawatt solar project, which will be commissioned slightly after we put first ore in mill, between 3 and 6 months, depending on the timelines, which haven't been finalized yet. Now, bearing in mind that the solar project doesn't give you baseload power, it gives you an offset. So you can take pressure off the grid when you're generating solar power during daylight hours. And that's where the technology I alluded to earlier about battery storage, long duration battery storage, becomes so critical. So we're investing in technology, our own technology, utilizing our commodities to store energy to create that baseload power. And we believe there's huge potential beyond our own application, and we'll be very excited to share that with shareholders and interested stakeholders in the future.
Excellent. Well, I will move on to the Q&As that have been posed, and do everyone ask any questions that you've got. Take advantage of the opportunity. I'll start with the ones that are most voted up. So we've got one from Mark here that's saying that, I have to say, they're slightly critical, some of these questions. I get the feeling that these are shareholders who like to hold your feet to the fire. So he's suggesting that your dividend policy of 15% of net profit is quite low compared to some of your peers, and asks whether you're looking to increase this in the future. And he makes the comment that Cairo doesn't seem to be adding much value currently to the market cap.
Yeah, and I think it's a question we get fairly often, and we do have a conservative dividend policy. And I think while we have the expansion program, it's most probably prudent to remain at this level. Having said that, when Cairo starts generating cash, once we've commissioned, there's certainly an opportunity to revise that dividend policy. So it's not too long in the future. You're talking about 18 months that will be in production, and most probably 24 months till we hit steady state. So certainly an opportunity then when we generate additional cash. We're doubling our PGM output, so you can look at what that potentially means in terms of cash generation. In terms of the Cairo project, yes, the market is not attributing any value to it, and I would go as far as to say perhaps they're penalizing for the development risk at this point in time. And it's something we've been discussing and debating with shareholders. And the comment is, we understand the logic and the rationale for diversification, for growth, for expansion, and these tier one resources come around once in a lifetime and require development. But this sort of window of capital, debt, and development risk most probably is penalizing us as opposed to getting the benefit of the doubt.
Yes, and I think that's possibly related to another of the questions that's had a couple of upvotes from Sam, who asks whether the 260 million senior finance facility has cost overrun conditions that could require you to raise equity if Cairo faces cost overruns. And I guess in general, it begs the question, how are you finding not funding, but implementing, building such a large project, given the current, global climate, that there still are constraints in some areas? So how is that? Is that going according to plan? May there be a cost overrun, and what is the implications if there is?
Sure, and I think it's a very valid question too. So when we priced the project, we were in peak inflationary environment with steel prices at record high levels. Iron ore was $220. So we've seen some relief in terms of the raw material prices. And in other areas, we've seen inflationary pressures, labor, transport, and so forth. So it's a bit of a mixed bag, but where we are today, we're on budget and on time, first of all. And where we've saved, on the one hand, we've run over, on the other, it's balanced itself out. So just to put it into context, we do have a 15% contingency baked into that $391 million. And we do provide an escalation provision of a further $26 million from Tharisa PLC over and above that. And that is really to account for any escalation or overruns, as you say. We're hoping that we'll maintain the current trajectory, which is on budget and on time, but there are certainly unforeseen circumstances in a volatile global climate that we live in. So I hope that answers the question as best as possible. Yeah.
When you say that, so far so good, on budget and on time, in terms of the general process, would you put a rough percentage on how far through that process you are? Are you sort of, halfway through?
So if you look at just the capital numbers, so we've spent $18 million and we've committed $60 million to date, so let's call it 78, and we're looking to spend $160 million. So we are most probably shy of 40% of the way there, and it doesn't look like it on the ground. I mean, there's a vast area that's been cleared and taken to bedrock for the civils to be laid. And so within, I would say, 6 months, there'll be heightened activity, and you'll start seeing major work coming out of the ground, as it were, plate work, steel work, and the installations. In terms of the long lead items, the ball mills, the flotation cells, those were ordered already last year because they were on the critical path because of supply chain issues and control system issues. And pleased to report that those are 85%. We just got an update report today on those long lead items. Those are 85% complete in terms of fabrication. Then they need to be shipped and delivered. So those will come well in advance of requirement and will be stored up until they need to be installed.
And presumably that they're at a price that was agreed at the time, and
correct, fixed pricing. So where we could lock in pricing, we did. The future packages that are being priced, as I say, are variable. The civils contract, as an example, came in lower than budgeted for. with the power line slightly more expensive because the national grid provider required a certain transformer that is a German brand, was slightly more expensive. So as I say, it's a fluid, very dynamic project, but got a very competent, capable team managing cost control, project delivery, scheduling, and so forth. Yeah.
Very good. So Sam asks a question that your Vision 2020 initially was looking to produce 2 million tons of chrome and 200,000 ounces of PGMs, and asking why have these targets not been hit yet?
Yeah, so a combination of factors. Firstly, the open pit at Tharisa mine not delivering the quality and quantity that's required on the one hand. So to achieve that 200,000 ounces, let's talk about the PGMs first. You need the head grade and the throughput to be consistent with the recoveries being at above 80%. And Sam will know well because he's asking the question, we've seen there's been a decline in all three metrics. The work that we're busy doing now is to get that ramp up back to where it needs to be, primarily from the open pit quality control and consistent feed. The processing plants we're confident are capable of doing that. On the chrome side, the Vulcan plant was earmarked to deliver that additional recovery and chrome production. While it works today and it produces very low cost, highly profitable tons, it's not at the original nameplate capacity that we had targeted in the Vision 2020 and beyond strategy. So it's most probably at 40% of where it could be. Again, we're working on improving that. To be frank, we may not get to the full nameplate capacity, but certainly we believe that we'll get closer than where we are now. And you can see some incremental improvements in our chrome production. We're currently hovering around 70% recovery. To get to that 2 million ton, we need to get to 80%. So there's some work to be done. It's in play, it's in motion. I think what Sam also needs to recognize is that when we add the 190,000 ounces from Cairo, we'll be closer to the 400,000 ounce level. So giving us that flexibility of multi-projects, so we're not wholly reliant on one cash flow. We have two very strong, healthy cash flows.
And what is it? So we've got someone very quick on the draw here. Robert is asking, what is stopping Vulcan hitting its nameplate capacity?
Yeah, so it's a novel process technology. So if you take from the first principle, the feed grade from the open pit, so the metal that you put in determines the metal you can take out. So if you're slightly compromised on the feed, it'll be impacted throughout the process. So that's the first aspect. So if the head grade is at the optimal level and the right quality and consistency, then you're starting off on an even keel and you're able then to recover optimally through the three processing plants. So when we look at Vulcan specifically, it's a three-stage processing plant, and it's three different technologies that we off-the-shelf technology, but that we combine together uniquely to recover the chrome concentrate. What we're targeting is what we refer to as ultrafine chrome that hasn't been recovered in the first two stages in the primary chrome extraction in our original Voyager and Genesis plants. So it's the first time that we're targeting, or the industry is targeting, these ultrafine particles. So the first stage is your conventional gravity separation, moving to magnetics and then further gravity type structures. And so if we miss the target, let's say we're at 90% of where we need to be in the first stage, it's compounding in terms of its efficiency or lack of efficiency. So what we found is that the sheer volume of 500 tons per hour of material running through this plant, it's a massive plant, it's a really impressive plant, has made it difficult to optimize the very first step, and then it has the compounding effect. So we're busy right now and positively improving the process flow, and the metallurgical team are working exceptionally hard on this, and we'll see incremental improvements getting towards that 80%. And so when we talk about Vision 2025 now, we're targeting those, let's say maybe they were aspirational targets in 2020. We're giving ourselves the breathing time to achieve them from the Tharisa mine alone by 2025.
When you, you know, I mean, it's very impressive when you talk about these projects. They're obviously huge things, the sort of things that you can probably only appreciate by seeing them actually in person. But when you talk about things like this Vulcan plant and the large amount of capital that you've expended over the last decade and now Cairo, do you foresee a time in a couple of years where the need for capex will be much lower suddenly? I mean, is it going to be a constant need to expand and improve and upgrade, or will you reach a sort of steady state where you've done pretty much all of the hard yards?
So yeah, I think these are the hard yards. I think you're right in that assessment. And I think once you have a diversified cash flow base and you have enough cash generation, gives you the flexibility to invest, to acquire other businesses that don't have perhaps the development risk profile that a startup operation has. So yes, I do see the capital intensity reducing. However, I need to qualify that we do have a diversification growth strategy. So perhaps we can be smarter with how we do it, or have more tools in our toolbox to execute on the strategy than what we have today. But yes, the intensity will reduce. Even if you look at the yellow mining fleet, which is a large capital stay in business requirement, as we replace it, as we move underground, that burden becomes less and less in terms of the mining methodology and so forth. So there are transitions to a lower capital intensity business in the future.
Okay, now we've got a good question here from Afan, who's asking, what is the current estimated IRR on Cairo? That it was suggested it was 26% last year, but the PGM basket was higher. And he's asked, has it fallen below 10% now? And if so, is the capex justified?
Yeah, so it's a great question on the back of the PGM basket price, and it's something we're running at the moment. So when we look at the original model, we had taken, I suppose, base case cost structures, and we generated the capital, the operating costs, and so forth. So what we've been doing vigorously and through fantastic skill sets in Zimbabwe as we've grown the team is refined our cost structures, operating costs, electricity costs, you name, diesel input costs, and we've refined that and looked for savings to offset some of those, well, not some, the reduction in PGM basket price. So we're below 20% IRR to date. We're still pushing to try and achieve that hurdle rate of 25%, but the basket price is under pressure. We are supported by the base metals, and one of the initiatives that we're looking at the moment is how do we capture more payable percentage of the metal. So we've been running a similar model to the way we sell our Tharisa PGM concentrate, which is on a percent payable of the metal content. We're looking at alternative options for the Cairo concentrate, whether it's a toll treatment opportunity, which potentially gives us more margin in the exit price. So yes, while prices have come off and we don't believe that they're sustainable at these levels and should recover, it does put pressure on us, but it focuses us in terms of our costs on the one hand, but also looking at capturing more margin in the exit price.
Excellent. So the only other question left is one which I think you answered, which was about the crime and disorder risk in South Africa, and how do you mitigate that?
So which risks are you talking about? All the risks?
Well, sort of I think crime and disorder in particular.
Yeah, look, so it's pervasive, unfortunately, and it's entrenched in many institutions. So you rely on your own resources and appointing cases, moving our goods by road because the rail networks through theft and primarily cable theft have been rendered almost certain lines almost unusable. And as they get repaired, then so the vicious cycle starts. And we've seen sabotage at Eskom power stations, and there's always a rationale, a fiscal rationale or an economic rationale to why people are doing this. And it boils down to pure criminality. So we invest in security. We have most probably significant resources in terms of securing our assets and our people, and then making sure that where we are exposed and where we have risks, we identify, mitigate, and clamp down on that. We're not immune to it by any means, and certainly are impacted by just general crime, and it goes to our employees as well. Just as a citizen of South Africa, it is a major concern and risk.
Yeah, no, well, that's understood. The one thing that you can't change with mines is the location of the resource. But of course, as you were saying earlier on, if people want chrome, there's no alternative. So that's the that's the size of it, really, isn't it?
Yeah, absolutely. And I think this really boils down to the theme that we've identified, which is supply side constraints. So all these extraneous factors put pressure on the supply side. So while demand at the moment may be muted, if we start seeing an uptick, there is going to be physical shortage of these critical raw materials because of these issues. And the solutions are not short-term solutions that are muted and tabled at the moment. They're medium to longer term solutions. And I have no doubt that as society, business, and the right parts of government, there will be resolution because we owe it to ourselves and our country to find these solutions. So in the interim, at least in the short to medium term, I think supply side constraints are going to be the main driving force behind stronger commodity prices into the future. Excellent.
Well, I think we've got through all the questions that we've been asked, and I've certainly learnt a lot about Tharisa, and very much enjoyed your presentation, Phoebus. So thank you very much for taking the time to do that.